corporation. So a corporation is a business owned by the stockholders or shareholders who own stock, which is representing shares of ownership in the corporation. So one of the major advantage of the corporation is that they are able to raise large sum of capital from issuance of stock. So the drawback of partnership is that if you want to gather $1 billion, it is really hard for partners to gather this much big amount since the risk is too high. So for corporation, the $1 billion is easy for them to arrange. They can issue stock, they can share the ownership with the public, they can go to the bank, and etc. So they have ability to raise large sum of capital. And corporation, they are formed under state law, and which means legally distinct from its owners. It means corporations are different than their owners. It's like a different entities in the eyes of law. So it can, which means company can sue with its own name. Like we have heard that Apple sue the Samsungs. It's not like that Steve Jobs or Tim Cook. It's suing the CEO of a Samsung company. So that's why corporation, in the eyes of law, they are like a separate person. So stockholders have no personal obligation for the corporation's debt. It means they have limited liability. Only the amount they have invested in the business in the form of purchasing shares, only that will be lost, and no other loss going to be transferred to shareholders' personal wealth. For the taxation purposes, corporation pay dual taxes. How? First of all, company, let me just, well, this is the company, it earned profit, it is taxed. The profit of the company is also taxed when company distribute the profit to the shareholders, it will be added in their income, and another taxation is applied on shareholders according to the income slab rates. So it means first company profit is taxed, and then company distribute the profit to the shareholders. When they receive the profit, then they are also taxed. So we call this dual taxation. So we just explained the dual taxation or double taxation. Corporation pay income tax, shareholders taxed on dividend distribution as well. So stockholders elect the board of directors, which set policies and appoints officers. So basically, company belongs to shareholders who are the owners, stockholders, and company is run by the managers. So shareholders, they elect directors, and directors hire managers who run the company in best interest for stockholders. So now we are starting our second learning objective, that is explain and apply underlying accounting concepts, assumption and principles. So in order to explain the underlying accounting concept, assumption and principles, accountants, they follow two frameworks. One is called GAAP, which is generally accepted accounting principle, and one is financial accounting standard board. So the International Accounting Standard Board, which is IASB, so this sets global or international financial reporting standards. So the diagram here gives you an overview of joint conceptual foundation of accounting. So the overall objective of the accounting is to provide useful information to existing or potential investors, lenders, and other creditors in making decisions about providing resources to the entity. So to be useful, information must have the fundamental qualitative characteristics, which is relevance and faithfulness. So when information is relevant, or it has follow the faithful representation, then the information would be comparable, verifiable, timeliness, and understandable. And also we should see the cost as well. If the cost of implementing the standard is too high, then it is a constraint. So we have to see that if financial reporting standards, we apply that with a minimum cost, and it should follow the accounting objective as well. So let's talk about the relevance. So to be relevant, information must make a difference to the decision makers. It helps predict or confirm the value and should be material. So in addition, the information must be material, which means it must be important enough to the informed user so that if it were omitted, it would make a difference in the user's decisions. That's what we mean by material. The next one is faithful representation. To make a faithful representation, the information must be complete, neutral, which means free from bias, with personal bias or whatsoever, and also free from error. So normally auditors, they sign the reports. So those person who are responsible for the verifiability of the figures that are presented in statements, they should be neutral and free from any error. Plus, the information must focus on the economic substance of a transaction, event, or circumstances, which may or may not always be the same as its legal form. So faithful representation makes the information reliable to users. And what do we mean by comparability? It means that the information that is provided by the companies, they are capable of being compared with the information from other companies as well. The next one is